Okay, hello everyone, and welcome to this special seminar for LW6660, Digital Finance and FinTech Law and Regulation. Today's session involves a guest presentation by Blake O'Donnell. You can see Blake on screen here currently, and he's also shared his presentation slides, which are also available on the Canvas page. To provide an introduction for Blake, Blake is a renowned expert on crypto assets and cryptocurrency. He's the author of a relatively recent, a 2024 Bloomsbury text, a book entitled Legal Aspects of Cryptocurrency in the UK. He's a qualified solicitor. He practices in England and Wales. He's also a consultant in relation to digital assets and distributed ledger technology, subjects which we've heard plenty about over the last couple of weeks. And he also serves an advisory role to startup firms in fintech. So it's certainly an honour, a privilege for me to welcome Blake O'Donnell for this guest presentation today. I hope you enjoyed the presentation. And obviously, please feel free to ask any questions that you may have. There will be a period after the presentation allowed for any questions, but you can also raise your hand during the presentation. You can use the chat function to enter any questions. But otherwise, I do hope you enjoy and that you benefit from the presentation. Thank you again, Blake, for making the time to speak with the students today. And a pleasure to introduce you.
Well, thank you so much, Jonathan, for the kind introduction. So I'm here to talk to you today about the evolving landscape of crypto asset regulation. That's my intro. Jonathan has kindly summarized it, so I can skip that slide. Just to say, I do consultancy work in relation to the crypto space. I'm currently on assignment with MiCA in London in their innovation department, working on interesting stuff in relation to algorithmic trading and also payments. So there's a lot going on in crypto besides what you hear about in the media, which generally focuses on Bitcoin, Ethereum, and what's known as the crypto zoo of other tokens. But there's a lot more going on in the space than people really realize. Okay, overview of crypto asset regulation. Fundamentally, crypto is a global issue. There has been a remarkable amount of international coordination seen over the last number of years in terms of global regulators trying to get a handle on the new technologies that have arisen. The policy development is at a supranational level, while for lawyers, it looks like it's all coming from individual jurisdictions. Actually, the ultimate guidelines are coming from supranational institutions, setting out roadmaps and policy papers and suggestions for how people should best tackle the crypto space so that there is global harmonization across borders. The problem with crypto is it's very mobile. It travels across borders. People can set up at a low cost and operate platforms. So it really is a global issue. Regulators at a global level are mainly focused on stablecoins and decentralization. The newspaper stuff that you hear mainly focuses on the main coins that people speculate on. The regulators view Bitcoin, Ethereum, Ripple, and other tokens as effectively a consumer protection issue. They don't really see it as anything that's going to affect the global financial system. What they do see as a threat to the global financial system are stable coins and decentralized finance. So from the point of view of a regulator, there's the bank payment system which handles transactions. So you've got your SWIFT, your FedWire, chips. There's a whole Visa, MasterCard. There's a whole list of these entities which handle bank payments. Now, with crypto, you can essentially circumvent the payment system. Now, with Bitcoin and other tokens, which essentially are not backed by really anything, that doesn't seem so much of a problem. The issue with stable coins is you can effectively set up a company offshore, do an initial coin offering on a one-to-one basis with a real currency, issue that token out into the market, and then that token can be traded like a dollar without using the payment system. There is an awful lot of currency which is out there globally, which is ending up in the stablecoin system. I think there's currently hundreds of billions of dollars backing stablecoins, and they are being used outside of the perimeter of the traditional financial system and out of sight of regulators. So they don't know what's going on within that ecosystem in some parts of the world. And obviously, from the point of view of anti-money laundering, counterterrorism financing, arms proliferation, that's a huge concern. Decentralized finance also is a concern for them, because people could be using those tokens for financial transactions, again, outside of the traditional banking system. So regulators were pretty much caught off guard by stable coins emerging in and around as a force in and around 2018, and there's been a flurry of coordinated action by various global regulatory bodies to get a handle on the situation. So you have the G20 Financial Stability Board, the International Monetary Fund, Committee on Payments and Market Infrastructures, International Organization of Securities Commissions, Financial Action Task Force, Bank of International Settlements, Organization of Economic Cooperation and Development. I'm going to take you through a whistle-stop tour of each of these organizations and explain to you roughly how they fit into the global financial system. The G20 Financial Stability Board, this was set up in 2009 at a G20 meeting chaired by Gordon Brown to deal with the global financial crisis. There was a recognition that the global financial system had become very interlinked and was not being monitored properly in terms of how banks were coordinating amongst themselves, and that they were very susceptible to shocks, as happened with the collapse of Lehman Brothers, which caused a massive recession worldwide. They tend to coordinate quite a bit with other entities like the IMF and the Bank for International Settlements, which we'll discuss in a moment. Their main remit is financial stability and regulation. IMF, this was established at the Bretton Woods Conference when the dollar became the global reserve currency. The members are 191. That's nearly every country in the world. Plays a crucial role in international and economic cooperation. It's basically the lender of last resort to countries when they run into difficulties, as Ireland found out some years ago. 3 missions: furthering international monetary cooperation, encouraging the expansion of trade and economic growth, discouraging policies that would harm prosperity. Committee on Payments and Market Infrastructures. This again was set up in the 80s to promote global payments. So the payment infrastructure that you see around you with that banks use for international transactions and for local transactions, that the Committee on Payments and Market Infrastructures has done a lot of work to bring that about. It sits within the Bank of International Settlements, and it does an awful lot of work with the next organization, which is called the International Organization of Securities Commissions. So these set the standards for securities regulations, so stock markets, debt instruments, bonds. A majority of countries have signed up to this. I mean, essentially, if you think about it, if you're a developing nation and you need to build a stock market or a bond issuance program, it's not easy to invent that from the start. So these are the people you would approach to get best practice guidelines and help you set one up. So they have been taking quite a bit of interest in how to actually structurally regulate the crypto market. The next entity is called the Financial Action Task Force. This was set up in 1989 by G7 countries. They tend to focus on anti-money laundering, counterterrorism financing, and arms proliferation. They have been very hot on cryptocurrencies going back a long way because it fell within their remit. In terms of when crypto started out as a nascent technology, a lot of the use cases, a lot of the usage on networks was to do with money laundering, drug trafficking, that sort of thing. The industry has vastly improved since then. But at the very start, the main concern was people were using crypto to circumvent existing financial regulations and the remit of FATF to stamp out money laundering and crime, essentially. Their definition of virtual assets has become very influential. A lot of jurisdictions have adapted this definition. A virtual asset is a digital representation of value that can be digitally traded, transferred, and can be used for payment or investment purposes. So this has ended up being slightly adapted in different jurisdictions. Bank of International Settlements, this was established in 1930, first international financial institution, set up after World War I to handle war reparations. In essence, BIS is the central bank of central banks. So they monitor what is going on in local central banks, and they assist with bank regulations. So if you're in banking, you will be familiar with the Basel frameworks in terms of capital, which sets out stringent rules in terms of what banks are and aren't allowed to do in terms of running their operations. They have taken a particular interest in crypto because banks are starting to hold it in the form of tokenized bonds, tokenized currency. They have to hold it in certain cases for clients. So they have gotten involved. The Organization for Economic Cooperation and Development, this was set up again after World War II to handle the Marshall Plan. It's had a change of mission since 1960, and now it focuses on global development and sustainable growth. You will often hear or read in a newspaper that the OECD has issued a new report talking about sustainable development or ranking countries in terms of achievement in education or standard of living, that sort of thing. Where they are extremely influential is in tax transparency. So their common reporting standard is what most countries use in terms of jurisdictions exchanging information between each other to stamp out tax evasion. They've taken an interest in crypto because people were using crypto to avoid taxation. So there's been a flurry of papers from these institutions over the last number of years, which are all very interesting. The main paper is the IMF FSB synthesis paper, which issued recommendations about global stablecoin arrangements and what the threat that they pose to potential threat they pose to the financial system and how they should be dealt with. They have issued a report recently with a roadmap of how various jurisdictions are doing. The Committee on Payments, CPMI and IOSCO, they have issued a report on financial market infrastructures in relation to systemic stablecoin arrangements. So again, the concern that one of the large stablecoins are effectively going to be used as currency in the financial system without oversight, and that is on people's phones without them fully knowing what the payments are being used for. The International Organization of Security Commissions, they have been at the forefront in working out how exactly crypto exchanges and crypto businesses are going to be regulated, and setting standards for what should go into legislation A lot of that has been seen in the EU MiCA legislation. They've also had some policy papers in relation to DeFi, decentralized finance. This is crypto providers offering financial services effectively in the crypto ecosystem. They recommended a principles-based approach to regulation in terms of depending on what the risk of the activity is, the regulation should be roughly the same as the traditional financial system. They also have issued a new report relatively recently on consumer protection. So they've done a deep analysis into who are the main users of crypto. They tend to be young, technologically fluent. Men are more attracted to it. They tend to be heavily influenced by social media, and they tend to get caught up in fear of missing out manias. So in terms of understanding the educating the consumer base in various jurisdictions about crypto, that's what they're recommending. Financial Action Task Force, again, this first report, the international standards on combating money laundering, financing of terrorism and proliferation. A lot of these standards have been adapted globally in terms of KYC, having to provide passports, utility bills, sources of funds, keeping a register of what's happening. They published an update recently about how the global rollout in terms of that regime is working out. They're not satisfied, but they have so many members, it's not surprising. Bank of International Settlements, as I mentioned earlier, they're in charge of setting bank standards in terms of capital. They've introduced this SCO 60 regulation, which provides fairly stringent capital requirements in relation to crypto, where you're holding a stable coin, which is properly constituted, effectively a tokenized currency or a tokenized bond. It's treated in a traditional way. If you are holding crypto, which is not backed by any asset, that effectively has 100% provisioning for in the bank's capital structure. They did a report in terms of what their view was on the crypto industry, and they came out with the conclusion that due to inherent structural flaws, it's unsuitable to play a constructive role in the monetary system. However, elements of genuine innovation can be replicated or embedded in safer, more trusted products in the traditional financial system. And this is happening as we speak. A lot of the technology that is used to run the crypto system is being bolted into the traditional financial system. And we're going to move away from credit and debit based ledger bank systems towards tokenized money and payments. That's where things are going. Organization for Economic Cooperation and Development. Again, I mentioned earlier that they have published their rules, their crypto asset framework in terms of governments monitoring crypto asset transactions and exchanging information between tax authorities. Okay, so moving on to jurisdictional implementation. EU and UK, you guys will be very familiar with the EU. It's a big topic, MiCA. As you can see, there's a long rollout for this regulation. It is effectively a big bang approach to crypto regulation. They have done an awful lot of work all together, all at once, and had quite a long rollout in relation to it. I understand Ireland is probably going to adopt it later in the year. I think the central bank has a tender out at the moment for people to come in and assist them with setting up their regulatory approach to crypto assets. Other countries are going to take a bit longer. They'll go up to the July 2026 deadline. Again, the MiCA definition has replicated the to some degree the FATF definition of crypto, and their main focus is on asset reference tokens, e-money tokens, and other crypto assets. So again, the stable coins and tokens which mirror real assets that could be used in the financial system potentially for payments is where the real focus has been on for them. The Bitcoin, Ethereum, all those other exchange tokens and utility tokens, they are mainly seen as a consumer protection issue. MiCA, strict licensing, consumer protection, and market integrity rules, and it applies to all crypto asset service providers across the member states. In the UK, we have a much more piecemeal approach. They have decided to sit back in relation to crypto regulation and see how the EU gets on with their regime. Interestingly enough, there's a bill before Parliament at the moment to define crypto as a new class of property. There was a lot of discussion in the UK courts about what crypto actually was, because it didn't neatly fit into any of the traditional classes of property. So this bill is being introduced to clarify that notwithstanding digital assets being a thing in possession or a thing in action, it is a piece of personal property. The UK jurisdiction is adopting a flexible case-by-case approach using the traditional financial system to regulate cryptocurrency. They have quite a developed system in the UK, so therefore they take the view that they can fit it within the existing paradigm. They have two classes of tokens: regulated tokens and unregulated tokens. Regulated tokens are security tokens and e-money. So again, you're seeing an emphasis on tokens that mirror traditional financial products that could have an impact on the financial system. And unregulated tokens, the exchange tokens like Bitcoin and utility tokens, which offer you some form of service in exchange for your fiat currency. They've given a definition of crypto asset. It's relatively similar to the FATF definition. The main issue in the UK has been crypto asset firms have had to comply with AML and KYC if you want to conduct business in the UK. This has caused problems for some exchanges who were operating in the UK but couldn't comply with the with the AML KYC obligations, and also the compliance issues that they would have had to go through with their platform. So a lot of providers have actually had to leave the jurisdiction. It's the FCA is focused on principles-based regulation. That's the Financial Conduct Authority. That's the regulator. The main discussion that generally happens in practice is whether a activity that a business is conducting falls within the regulatory perimeter or it falls outside the regulatory perimeter. So with crypto, a lot of times that might be quite nebulous. The FCA roadmap in terms of where they're going with their MiCA style regime, as you can see, in 2020, money laundering regulations were introduced. They have introduced a fairly strict financial promotions regime in terms of people doing predatory promotions to get people to buy tokens. Those have been clamped down on. There's a lot of discussion papers, consultation papers, and policy statements all lined up to be issued on elements that are currently in MiCA, and roughly we're looking at something to look at in terms of legislation in 2026. When I was writing my textbook, I had hoped I'd be seeing some stablecoin regulation at the moment, and maybe even some crypto asset service provider draft legislation at about this stage, but it doesn't look like that's going to happen for another year or two. So in terms of jurisdictional implementation, EU has taken a very strong approach, strong disclosure requirements for crypto issuers, investor rights and protection measures, mandatory white papers letting people know what exactly they're buying when they participate in an ICO, and segregation of crypto holdings from the provider's own assets. This has been a massive issue. A lot of crypto businesses were not segregating their customers' assets from their own. So, and the famous example, of course, is FTX, which went into insolvency in 2022, causing absolute chaos. MiCA stamps that out and says that they have to segregate their holdings and provide a proper plan for what happens if there is an insolvency. The FCA has focused mainly on crypto ads, clear risk warnings, ban on retail sale of crypto derivatives. So if you're on a crypto platform, you cannot buy derivatives if you're a retail investor. Of course, if you are a sophisticated investor or an institution, you're still allowed to trade derivatives. And again, against misleading promotions. So when I was on the tube a few years ago in London, you would see ads for various odd tokens being promoted on the tube. They have all disappeared. Stablecoin regulation, EU has taken a very strict approach to this. This is having real effects. A lot of tokens have been removed from exchanges because they cannot prove their reserves. I think Circle is licensed on exchanges. Tether has been removed from crypto exchanges. For those who don't know, Tether has been in an ongoing debate with people who own their tokens about actually, providing an audit to show that they have the money that they say they have backing the tokens. That has gone on for a number of years. And there's additional financial oversight for significant stable coins. So these are stable coins which are in use and are being used for payments. That is the real concern of regulators, the idea that you could be holding a stable coin on your phone and be using it to pay for products in the real world, in the supermarket. The idea of that is of great concern. And if one of those stablecoin providers collapses into insolvency, what happens to the financial system? So a proper regime is being put in place to make sure that these entities are actually properly run like a traditional financial institution. The UK has introduced something similar under FSMA 2023. At the moment, it's still an evolving framework. If you want to set up a stablecoin operator in the UK and issue tokens, you're going to have to go talk to the payment services regulator. No, there isn't a huge amount of comment on what exactly, because there's not that many who have opted to actually do that in the UK. It's still work in progress. Innovation sandboxes, both the UK and the EU have their own sandboxes. So if you are a crypto startup and you want to try something which would otherwise be banned under financial regulations, you can approach, you can participate in one of these sandboxes and get an exemption. So they put guardrails in where you are allowed sell your product to investors or whoever your market is within certain parameters, and they can monitor what's going on. I think the EU, as far as I'm aware, has taken a relatively sector-specific approach. So they've said we want businesses within these types of activities, such as settlement of transactions or DLT blockchain in relation to IDs, that sort of thing. The FCA is more case-by-case basis. You approach them and they'll decide whether you're allowed or you're not. They're not a sector-specific. Cross-border regulation, as I said, MiCA is a big bang approach. across the jurisdiction. You're passported to operate in markets. And they really are focused on regulatory arbitrage. They want everyone in the regime, and they don't want people picking and choosing where they are set up to avoid regulation. I've read some papers at the moment that they're quite concerned about reverse promotions, where crypto providers will be set up offshore doing their trading and their custodian services, and using a EU regulated entity to effectively act as a broker to move the business offshore. So they're currently looking at at stamping that out at the moment. The FCA, post-Brexit, it's not passported. You need your separate license for the UK if you want access to the UK market. The FCA, I've just picked out some steps that the FCA have taken over the years in relation to crypto to ensure that consumers are protected. I've mentioned they banned crypto derivatives. They've introduced stringent AML registration requirements. The tax authorities also communicate with these exchanges to make sure that there's tax compliance going on. Enforcement against unregistered firms. There was a big crackdown in 2023 about crypto firms who were operating within the jurisdiction with no licenses, and business premises were raided and arrests were made. There is a list of unregistered crypto firms that are operating in the UK jurisdiction without a license, and you can look at them on their website. Advertising restrictions, I mentioned that earlier. Binance had issues with the UK regulator and has since halted all its activities in the UK. Existing customers are still allowed to access the platform, but they're not taking on any UK-based customers, and there is no access to derivatives, etc. Revolut also got called up by the FCA on offering crypto through their payment app without putting in place consumer protections. In terms of what this looks like out there in practice, if you're advising a crypto business or a startup, you're going to have to be keeping up with the regulatory trends. But what I would say in relation to that is you should really get a handle on your local jurisdiction first before you get totally embroiled in every crypto update globally. Regulation and what's happening in various markets is huge in terms of keeping track of everything. It can get very confusing. What you should really do is learn the jurisdiction you want to practice in inside out, and then once you've done that, you can bolt in knowledge about other jurisdictions. But if you are constantly looking at researching what's going on in Singapore or what's going on in the Marshall Islands or whatever, it will just become very unwieldy. You do need to know about cross-border elements, but know your own jurisdiction very well, because ultimately that's what they're going to ask you to be advising on. What is happening in Ireland? What is happening in the UK? How does MiCA affect me, etc. Implementation of robust compliance frameworks. Again, a lot of crypto providers, they are set up by individuals who are often not from a traditional financial services background. A lot of the compliance element is a bit alien to them, and their first inclination is, how do I get around it? And it has to be made clear to them that you can't get around it. You have to do these processes, and if you don't, there are really serious consequences. There are options available for people to effectively contract out some of their compliance functions to other providers, and that's perfectly acceptable. Engaging with regulators, Businesses need to be proactive. Again, taking your responsibilities seriously and not trying to skirt them. There is this attitude that the regulators are totally against crypto. In fact, they're not. All the policy papers, all the regulatory papers say that that crypto is here to stay. It's something that has to be integrated properly into the financial system, and they want people to participate in their digital sandboxes and let them know what's going on, rather than have a situation like has happened before, where suddenly something like stablecoins spring up relatively quickly and everyone is scrambling. They want to know what's going on, and they want to integrate it properly into the financial system. Structuring for flexibility, again, making sure that the corporate structures for your clients are properly set up in the right places, and everything is done properly so that the corporate structure of your client isn't at risk in case something happens in a particular jurisdiction that is unforeseen. The future. So again, in my book, I have extracted some of the key policy elements in these reports that I've had to go through. A lot of the regulators do actually give you a picture of where they think digital assets, crypto assets, cryptocurrencies, all of the crypto arena, where they think it's actually going in the future, and what rules they are going to have to put in place in order to deal with it. And some of it is absolutely fascinating. And as lawyers who are going out there into the world to practice, this is a totally new. When I qualified as a lawyer, the idea of being a digital assets lawyer or a DLT lawyer didn't exist. It's sprung up in the last few years. You will not find someone who has 20 years of experience with crypto, because crypto did not exist. So, these are elements that are coming in our direction in the future, that it's probably worth your while taking a look at, to say this might be an area which I will read up on, get interested in, and you might find yourself in 10 or 20 years being an expert in these areas. So, growing influence of crypto assets. All the regulators and bodies agree that crypto assets are a growing influence. They are tokenization of real world assets is being taken extremely seriously. Boston Consulting Group have come out with a report saying about 15% of global GDP could be tokenized over the next maybe 10 years, 20 years, something like that. Assets which traditionally people have not had market access to. So things like shipping, you have access to real estate, but not through a tokenized trading mechanism. So this would be publicly available without the use of a stock market. BlackRock, the asset management firm, has currently embarked on a tokenization project to tokenize all its asset management processes. So all the assets that they hold, they want tokenized so that they can manage them more efficiently in their corporate structure. All of this is coming down the line, and the drivers behind this is the efficiency and reduced costs. It eliminates intermediaries, and you can effectively run almost like a stock market trading program for very little money, without a listing. So for asset managers, for people dealing in assets, the idea that you could tokenize things and move them efficiently between investors really is exciting to them. Regulatory clarity is emerging. So MiCA and all these regulatory activities are actually extremely good for the industry, even though the industry players don't love them. Fundamentally, you need traditional financial institutions and investors to feel that their money is safe, to feel that if something goes wrong, the legal system is going to be there to assist them. They cannot invest in things that are unregulated and there are no laws surrounding them. That's not possible. So the more sophisticated the legal regime becomes in relation to crypto assets, the more you're going to see big institutions get involved and fund very interesting projects. Crypto assets and financial services, this is a real focus in the industry. People want to use DLT to effectively make their back offices more efficient and make sure that they can move traditional financial assets quicker around the ecosystem. Smart contract technology is also extremely useful in terms of derivatives and other financial transactions, in that events can trigger movement of tokens from one person to another without the intervention of an individual. The broader industry applications, supply chain and traceability. This is a pure DLT thing using tokens again. The idea that you can trace objects through the supply chain is very exciting to some people. There was big publicity around LVMH introducing DLT to track luxury goods. So they put a chip inside a bag, and you can track who bought the bag, who now owns the bag, if it's legitimate, etc. That is a very simple, understandable example of what could be applied throughout the supply chain system. Healthcare, the idea that essentially people would have their private health records stored on DLT in a secure manner, so that when someone turns up at a hospital, their medical records could be safely accessed and read without having the normal situation where family members have to be asked what their medical history is, or files have to be got from the GP or another hospital, etc. All of that could be handled through DLT. The UK government is already implementing some of this at the moment. Internet of Things, again, the idea of having smart objects. So instead of having a centralized database controlled centrally, of distributed databases which these various objects plug into. And this could be the way that we get the smart city that you see in science fiction films, where all the various vehicles, machinery, traffic lights, everything is interlinked through distributed ledgers. Web3, this is the aim to decentralize the internet, again using DLT. So the internet has become very centralized using big tech. The aim of this is that your personal data would be held by you, and you simply plug into the interface, rather than all your data being held in one big database held by Facebook, Google, whoever it is. It's about taking back control of your own personal data. It's a movement. We'll see over the long term. We'll see over the medium to long term how it works out. Decentralized autonomous organizations. These are new governance models based on DLT. A lot of crypto startups are funded by these. They function like partnerships. You have a general partner, and then you have other partners who vote on making investments decisions. When these came about, they were simply software running crypto tokens with no legal wrapper. Many jurisdictions are in the process of setting up an actual legal designation for DAOs, a special regime, including the UK. I think Switzerland already has one. That is something that is coming down the line as well. Central bank digital currencies, an absolutely huge area of discussion at the moment. In brief, the idea of the central bank digital currency is you can use electronic money without a bank. So if you have an Apple Pay or a Google Pay, instead of having your bank card in that wallet, you will simply have digital euros, digital pounds, digital dollars, whatever currency you want to interact in. The idea that you would have a wallet, probably with your local central bank, and you would have CBDCs in it, offers all sorts of opportunities to do very interesting things with the financial system. So streaming payments could theoretically be possible, where essentially if you pay for an Uber or some other service, the the payment directly goes to the driver almost instantly, with Uber taking its fee rather than the driver having to wait till the end of the month. UBI as well. We could potentially be seeing a UBI with the advent of CBDCs. Blanket transaction tax across the system of about 1%. And then that 1% is divided by the users in the jurisdiction, and a sum of money is put back into everyone's wallet. That could be very interesting in terms of lightening the load on the systems that are required to run social welfare and pensions. So just in terms of challenges, regulatory framework, not striking the balance between encouraging innovation and over-regulating so people don't participate in the jurisdiction. Scalability and interoperability, all of this stuff is terrific, but all of these various ledgers have to talk to each other and operate together, and that's easier said than done. A lot of work is currently being done on that at the moment. Security and privacy, preventing hacks, preventing cyber attacks, especially in situations where money is completely digital. The idea of a cyber attack on the financial system could be devastating. Environmental sustainability, a lot of crypto projects consume a huge amount of energy, and the more the economy becomes cryptified, the more energy it consumes. So making sure that the system is running in the most efficient manner possible. Okay, and future outlook: increased adoption. Traditional financial sector is going to move towards tokenization. It's already happening. And we are going to see the tokenization of fiat money and banking in the next decade. You're already seeing it with the popularity of apps like Revolut, with Apple Pay, Google Pay. All of these things are effectively crypto ideas. So it's already in train. There's going to be a huge amount of interest in payments over the next 10 years, and lawyers dealing with the financial system moving away from the traditional bricks and mortar bank, credit and debit ledgers, towards a more tokenized based money system. And with that, I will conclude my presentation, and I'll open the floor to any questions or comments you might have.
Thank you once again, Blake, for an excellent presentation. As Blake has invited all of you, please do feel free to ask any questions that you may have at this point. If you feel more comfortable about it, I can pause the recording right now. But again, an excellent presentation, Blake. So if anyone has any questions, please feel free to raise your hand or to enter a question into the chat function.